What I'd look for if I were buying stocks today, 2026. If I were buying stocks today, in 2026, I would begin by reminding myself of something many investors forget during every cycle. The stock market is not a prediction machine. It is a pricing mechanism. Prices reflect expectations about the future, not certainty about it. When expectations are too optimistic, disappointment destroys value. When expectations are too pessimistic, opportunity quietly forms. The task of an investor is not to forecast headlines, but to understand what assumptions are already embedded in prices and whether reality is likely to be better or worse than what the market expects. To decide what I would look for today, I would first ground myself in where we actually are in the economic cycle. The world has moved through an extraordinary period. Between 2020 and 2022, global stimulus flooded markets with liquidity. Asset prices inflated rapidly. From 2022 through 2024, central banks reversed course at historic speed, raising interest rates aggressively to contain inflation. By 2026, inflation has moderated from its peak, but it has not returned to the ultra-low environment of the 2010s. Interest rates are no longer an emergency tool. They are a constraint. This single change alters almost every assumption investors learned over the past decade. In this environment, the first thing I would look for is real, durable earnings. Not adjusted earnings, not future earnings, not earnings that depend on perfect execution 5 years from now. I would look for companies that already generate consistent profits through multiple economic conditions. Historically, during periods when real interest rates remain positive, companies with stable earnings outperform those relying on rapid growth. That is not because growth disappears, but because the cost of capital forces markets to reprice risk honestly. Closely tied to earnings is free cash flow. In 2026, free cash flow matters more than revenue growth. A company that converts a large portion of its revenue into free cash flow can survive downturns, invest selectively, return capital to shareholders, and reduce reliance on external financing. Data from previous tightening cycles shows that companies with strong free cash flow yields experience smaller drawdowns during market stress and recover faster afterward. If I were buying stocks today, free cash flow would not be optional. It would be foundational. The second thing I would examine carefully is the balance sheet. Markets forgive many things during booms. They forgive leverage. They forgive complexity. They forgive weak liquidity. Crashes do not. In 2026, after years of higher rates, balance sheet quality has become a decisive differentiator. I would look for companies with manageable debt levels, long debt maturities, and interest coverage that remains comfortable even if earnings decline. Historically, firms with net debt below 2 times EBITDA have dramatically lower failure rates during recessions than those with higher leverage. This is not about avoiding risk entirely. It is about avoiding fragility. Liquidity would matter as much as leverage. Cash on the balance sheet provides optionality. During periods of stress, companies with liquidity can continue operations, maintain strategic investments, and acquire weaker competitors at discounted prices. Companies without liquidity are forced into defensive decisions at the worst possible time. If I were buying stocks today, I would treat liquidity not as idle capital, but as insurance. The third thing I would focus on is demand stability. Not all revenue is equal. Some demand is discretionary and disappears quickly in downturns. Other demand is persistent regardless of economic conditions. In 2026, with growth slower and consumers more cautious, companies serving essential needs stand out. Healthcare, utilities, insurance, basic technology infrastructure, and certain industrial services exhibit demand that is less sensitive to economic cycles. This does not mean their stock prices will not fall during market sell-offs, but it does mean their underlying earnings base remains intact. Over time, earnings stability anchors valuation. Pricing power would be another critical filter. Inflation may have moderated, but cost pressures have not vanished. Companies without pricing power see margins compressed when costs rise. Companies with pricing power protect profitability. Pricing power often comes from brand strength, regulatory protection, switching costs, or network effects. In every inflationary or post-inflationary environment, companies with pricing power outperform those competing purely on price. If I were buying stocks today, I would ask a simple question. Can this company raise prices without losing customers? I would also look closely at business simplicity. Complex business models often conceal risk. When markets are calm, investors tolerate complexity. When markets are stressed, complexity becomes a liability. Companies with simple, transparent revenue models and understandable economics tend to retain investor trust during downturns. Transparency reduces uncertainty, and uncertainty is what investors sell first in a crash. If I cannot clearly explain how a company makes money and why customers stay, I would be cautious. Another factor I would consider in 2026 is capital discipline. During the era of cheap money, many companies pursued growth regardless of returns. Capital was abundant, and mistakes were forgiven. That era is over. In today's environment, companies that allocate capital efficiently outperform. I would look for firms with strong return on invested capital, disciplined capital spending, and a track record of returning excess cash to shareholders through dividends or buybacks. Historically, companies that consistently earn returns above their cost of capital create long-term shareholder value, especially in slower growth environments. Valuation would be impossible to ignore. Even the best company can be a poor investment if purchased at an unrealistic price. In 2026, I would be skeptical of stocks priced for perfection. When expectations are extreme, downside risk dominates. Conversely, I would pay attention to companies trading at reasonable multiples relative to their earnings and cash flows, especially if those businesses have durable advantages. Valuation is not about finding cheap stocks. It is about avoiding overpaying for certainty that does not exist. Sector selection would also matter, but I would approach it carefully. Rather than chasing themes, I would focus on economic logic. In a higher rate environment, sectors benefiting from stable cash flows and pricing power tend to perform better. Select financials, particularly well-capitalized banks and insurance companies, have regained profitability as interest margins normalize. However, leverage and asset quality matter more than ever. I would avoid blanket exposure and focus on individual balance sheets. Technology remains a core part of the global economy, but I would be selective. The distinction in 2026 is between speculative technology and essential technology. Companies providing infrastructure software, cybersecurity, cloud services, and data management are now embedded in everyday business operations. Their revenues are recurring, their customers are locked in, and their services are difficult to replace. These firms behave more like infrastructure providers than growth experiments. By contrast, unprofitable technology companies dependent on future promises remain vulnerable when capital is constrained. Healthcare would also remain an area of interest. Demographics are not cyclical. Aging populations drive long-term demand regardless of economic conditions. Pharmaceutical companies with diversified pipelines, medical device manufacturers with recurring revenue, and healthcare service providers with scale advantages all benefit from structural demand. Historically, healthcare stocks deliver strong risk-adjusted returns during periods of slower growth, and 2026 fits that pattern. Geographic exposure would factor into my thinking as well. While global diversification remains important, different regions face different challenges. The United States benefits from innovation, energy independence, and flexible labor markets. Europe faces slower growth and demographic headwinds, but still contains world-class industrial and export-oriented firms. Emerging markets present opportunity and risk, depending heavily on fiscal discipline, currency stability, and political conditions. I would focus less on country labels and more on company-specific fundamentals. One area I would be cautious about in 2026 is excessive leverage, regardless of sector. Highly indebted companies face rising refinancing risk in a higher-rate world. Businesses dependent on discretionary consumer spending without pricing power are exposed if households remain cautious. Speculative growth stocks reliant on capital markets rather than internal cash generation remain fragile. These risks are structural, not temporary. Dividends and shareholder returns would play a larger role in my decision-making. In an environment where capital gains are less predictable, income matters. Companies with sustainable dividend payout ratios and a history of dividend growth provide tangible returns even when markets are volatile. Over long periods, dividends account for a substantial portion of total equity returns, particularly during sideways markets. In 2026, income is not old-fashioned. It is rational. Another aspect I would consider is ownership structure. Stocks dominated by short-term traders or speculative investors tend to experience more violent swings during market stress. Companies with stable institutional ownership and long-term shareholders exhibit more orderly price behavior. While this is not decisive on its own, it provides insight into how a stock may behave under pressure. Perhaps most importantly, if I were buying stocks today, I would focus on avoiding permanent loss rather than maximizing short-term upside. Volatility is inevitable. Loss of capital is optional. Stocks that collapse permanently usually share common traits: weak balance sheets, fragile business models, excessive optimism, and reliance on external financing. Stocks that survive share different traits: cash generation, discipline, resilience, and adaptability. In 2026, investing is no longer about riding waves of liquidity. It is about selecting businesses that can operate in a world where money has a cost and growth is uneven. The stocks worth buying today are not necessarily the most exciting or talked about. They are the ones quietly compounding value, protecting margins, and preparing for uncertainty. If I were buying stocks today, I would not try to predict the next correction or rally. I would assume volatility will return, as it always does. I would focus on companies that can endure stress and emerge stronger. History shows that markets reward patience, discipline, and realism far more reliably than excitement. And that, ultimately, is what I would look for. Not certainty about the future, but evidence of resilience in the present.